Are bonds back in favor in the U.S.? Yes, corporate bonds are attractive in the U.S. Not only do you have an attractive coupon, but the average bond trades below par. So while credit spreads are tighter than historical averages, the credit fundamentals are also improving. When we think about earnings growth, small and mid-cap companies are beginning to see earnings acceleration, as well as the Federal Reserve cutting interest rates and the stimulus from the One Big Beautiful Bill. All of that leads to credit metrics that from a historical perspective are better than expected. Is the high yield market still attractive given tight credit spreads? The answer is yes. Not only do you have an attractive coupon with high yield, but you also have the average bond trading below par. When we look at the credit metrics, we're also beginning to see improving credit metrics, and that's largely driven by cash flow and earnings growth. When we look at the new issue window also for high yield, a majority of the new issue is going to refinancing maturities. So right now, we don't see any real near-term maturities in the high yield market. So when you put together improving fundamentals, not a lot of maturities, that leads to a low default risk in the high yield market. So while we understand credit spreads are tight, if you look at it from a historical basis, credit spreads can stay tight for a long period of time. So when we think about the high yield market, it's really about collecting coupon, and there's no reason going forward we shouldn't see coupon-like returns for the high yield market. What is a U.S. convertible bond? A convertible bond in its simplest form is a fixed income instrument plus a warrant or an option on an underlying equity. So it really has the both of best worlds. It has the downside protection of a bond and the unlimited upside of a common stock. And when you put those two elements together and you look at the long-term return profile of convertible bonds, you get equity-like returns with a lot less volatility. In the U.S. convertible bond market, are most bonds in the money or out of the money? When we think about the U.S. convertible market, we really like to talk about three different types of buckets. One is called equity-like convertibles. That means that they're in the money and trade and behave more like equities. That currently makes up about 25% of the market. The other side of it is bond-like or yield-oriented convertible bonds that trade more like fixed income instruments versus equities. That makes up roughly about 40% of the market. When we think about the last bucket, we call those total return convertibles, which have the ideal characteristics that we like in a convertible bond. These total return convertibles offer 60 to 80% of the upside and 50% of the downside. That makes up just over 30% of the convertible bond market currently. What's most exciting about the convertible bond market today in the U.S. is new issuance. What new issuance brings is total return opportunity. In 2025, we're on pace to do close to $100 billion of new issuance. That compares to what we saw over the last couple of years of roughly $30 to $60 billion of new issuance. With this large new issuance coming to the convertible market, that brings lots of new total return opportunity. Name 3 investment keywords for 2025. Income, participation and protect, diversification. When we think about income, every investor likes income and wants income, so that's always key to any investment. 2, participate and protect. With volatility increasing in the equity markets, why not have a structure and an ability to participate on the upside, but more importantly, protect on the downside? Diversification. It is important to always have diversification in the portfolio and not be too concentrated in any individual name or any individual fund.